Today we're going to go over continuing our discussion for peak formation, stop hunting, and putting it all together in terms of trading the market maker template. Stay tuned, traders. I think you'll get a lot out of this video today. We'll be right back. Good day, traders. Stacey Burke from Stacey Burke Trading. The last few weeks we've gone over stop hunting. We've gone over M&W patterns, candle confirmation patterns. We've gone over the 12 candle rule. We've gone over the different time frames and how the market will consolidate, stop hunt, trend, consolidate back into the Asia session. We've gone over some of the different little nuances in terms of the news and using that. Today I'm just going to walk you through my step-by-step approach to the market on a daily basis that puts all that information together. I think that it will tie in a lot for a lot of the traders that have emailed me a ton of questions. I've had a lot of fantastic feedback. Thank you. I'm going to talk about a couple of other things at the end as well. But let's get started. So the most important thing that you can identify each and every day is the pattern of the trend. Are you in an up template, a down template, or an uptrend or downtrend, or a range-bound sideways market? If you know where you're at, are you in level 1, 2, or 3? And often I'll start with the end of day, so I'll be looking at, am I in that monthly cycle? Am I in an upward market? Am I in a downward market? Or am I in a range-bound market? And in my day-to-day, I use the 15-minute charts. We've talked about level 1, level 2, level 3. Last week in a lot of the British pound pairs, we had a downward market. So you could even just draw your falling trend line down. But then, of course, we talked about level 1, don't counter trend, a level 1 trade. That tends to be the straightaway trade. That's a very strongly moving market that's designed to capture a lot of traders in margin stress and basically wipe out their accounts. And remember what we talked about, following the money. The market will move to where the money is. So the most important aspects that you can always try to master and focus on are the high and the low of any time frame that you're trading on, because that's where largely the most orders are, the most stop losses are, and where the money is. Number 2, how did the market close last night? So if you're in a downward, if the market was a down day yesterday in a downward template, did the market pull back in the US close or towards the end of the US close and consolidate, or did it close towards the low of the day? If it was an upward day, did the market close towards the high of the day, or did it pull back and consolidate? That can tell you a lot of information about the peak formation. So we have our larger peak formation, the most lowest peak formation and the highest peak formation. So you've got two areas that the market's always trading in. Now, if you're in a downward market, obviously you would have that M and peak formation from a level 3 that's come down. So if you had a downward day and the market's pulled back and consolidated, we talked about last day looking at the levels. One of the most important things you can do is identify from the last peak the highest closing bull candle low. Now, I'm not talking about large momentum candles. I'm talking about normal 15 to 20 pip candles if you're on that time frame, marking off the low where the last peak formation occurred, the last swing high occurred. Same thing for the low. If you're in a consolidation, you want to mark off the most recent low of the highest bull candle and the most recent high of the lowest bear candle. The reason why that's important is because if you're in a downward template, as we head into the Asia range, we'll be looking for our high and low. Again, we talked about between the numbers, and we also talked about the previous day's high and low. Those are significant areas in terms of where there are large amounts of orders. Again, where the money is. As Europe and London open up, I look for the stop hunt. The stop hunt does a couple of things. Number one, it tends to trigger breakout entry orders from larger time frame traders and also breakout traders. That will often occur with 3 strong drives. And if we're in a downward template, I will be looking potentially for that to be occurring up into that 25 to 50 pip range. Now, if that stop hunt was to occur low and I'm in level 2 or level 3, I will still possibly look for something at the low of the day that gives me an opportunity to buy, but I'll be looking for at some point either at the numbers or at the most recent high of the day for that trade to potentially exhaust itself. What that stop hunt does in that 25 to 50 pip range is it triggers the breakout traders, but it also triggers technicals. So a lot of that is around the manipulation tactics of triggering the technicals and enticing a lot of the retail money into the market based on what their technical systems give them as a valid trade entry signal. So we talked about between 2 a.m. and 5 a.m. New York that potentially a high or a low of the session and potentially the day may occur. Now, if you understand that where the money is, once they have potentially put a peak formation in place for the day, so we talked about the peak formation going into the session, but also a peak formation for the day, if there's a short selling signal to go back in line with the original trend, once that money is trapped and they've got a lot of these people trapped into a bullish market, if they go back up to that level, it unlocks those traders from being in losing positions. So if you've ever been in a losing position and you see the market come back towards your position, but it never fully gets there, you know, maybe a few pips away or 10 pips away, and you've told yourself, if I can just get back out at break even, I'll do that. And so often the market will not go back to that level because it allows a lot of money to be unlocked back into the market. If they keep moving further and further away, it increases the amount of pain and potential losses, especially if retail traders have lifted their stops, not used a stop, or averaged into losing trades. So that 2 a.m. window, 2 a.m. to 5 a.m. window is where we talked about using the 12 candle rule. Now also between 8 a.m. and 11 a.m. New York, the same rules apply, and I use the same 12 candle window again. Now I've had a lot of people say, well, that's 3 hours, isn't that a lot of time? I'm looking for one great trade. Now there's trades every single day and I will try to scan 8 or 9 of the markets looking for the strongest potential setups in those pairs. Now I tend to focus mainly on the pound pairs, but ideally you're looking for markets where there's a lot of strong momentum already in the market. And the reason why that is that there's a strong likelihood when the setups are right that the market will continue to do what it's already been doing. So I don't try to trade the same market every single day. I try to look for the markets that are going to give me the same setups with the least amount of interference to that market producing the potential outcome that I'm looking for based on that setup. Candle confirmation, price, and numbers. So that 12 candle rule is very specific, and as I get closer to the end of that 12 candles, 90% of the time there's always a trade. So as I get closer to that 12 candle, end of the 12 candle window, based on my experience in chart time, I know that I'm about to get the potential setup that I'm looking for, and that might be a hammer up high after that 25 to 50 pip stop hunt into a peak formation swing high, or I may get a set of railroad tracks, or some people call it an engulfment pattern, maybe on a smaller time frame that may be an M pattern. If it was an up market, it might be a W, or pin bars. Those pin bars often represent stop hunts where the market's gone up, flushed out break-even traders, triggered other entry orders up into that area, and then come back and closed below the peak formation that has been in the previous session as the market was heading into the close. To just talk about that, as the market closes and it comes back into consolidation, that's ideal. If we see the market come down and close towards its low into the rollover time of the end of day, that is not a peak formation low. The market will often continue down and then eventually pull back and give us a consolidation into the Asia range. Our peak formation low therefore would be into the new day. When we enter the trade, what we're looking to do is minimize our risk in that position and maximize the potential profit on that trade. So if you're going to be taking a 15 to 20 pip risk trade, maybe 12 to 15 pips, you're ideally looking to be 12 to 15 pips from the high of the day or the low of the day if you're going long. Now, that doesn't mean I'm trying to call the high or the low. What that means is that based on my setup, my price action, the trend that's in place, the level of the template that we're in, and how the market has moved and stop hunted out of the Asia box, ideally my loss should never be greater than 15 pips. And if you look at most of the markets, they move in 1/8 increments. Even though they're larger 25 pip ranges, usually they're 12.5 pip increments, which are 1/8 that will move to either side of the numbers. Now, if the market is strongly rejecting off of a quarter level, a 25, a 75, or a 50 level, but then also double zeros are very significant for a lot of the pairs. So you'll often notice if you scrunch up your chart, there's a great free indicator called Sweet Spots, which shows all your number levels. You'll see that the double zeros tend to play a significant role for a lot of the currency pairs, which means ideally that there are 100 pip increment movements for trades. So it's always important that you're targeting, 3, 4, 5, maybe 10 to 1 on your trades, and that's what makes taking your loss a lot easier. And again, chart time will show you that 12 candle window on the 15-minute charts often produces an opportunity for traders to take an asymmetrical trade type setup in line with the trend that they're already in, and sometimes a counter trend. But again, on level ones, be careful not to counter trend on level one. One of the things that I'll just point out is that if you're getting in a little early or a little late, your maximum stop should never be more than 25 pips. And the reason why that is that if the market moves in 1/8 increments, 12.5 pip increments, if it goes past that and moves 25 pips beyond and you're pushing past a number level more than 25 pips, chances are you are dead wrong. And you want to make sure you get out of that trade as quickly as possible, because if you're wrong, it could potentially be a measured move and be going 25, 50, maybe 75 or 100 pips against your existing position, especially if you're at a quarterly level low or high, or a weekly level low or high. The market could continue to move strongly for 2 or 3 days or longer in the opposite direction. And the other thing that can interfere with that existing template is news, and we just had that happen on Friday night with payrolls. Often we'll see payrolls days move earlier in the session, and then as Europe and London open, continue to move, attracting more people into the markets, at which point the payrolls announcement often tends to spike and stop hunt a lot of those people who got in late, or it may stay consolidated and then stop hunt before it breaks out, pending the release of the non-farm payrolls. Often, again, it just comes back to your setup that you see on the chart. Sometimes payrolls can give a very perfect technical setup with an M or a W type pattern after it's pushed out 50 pips or so. But again, it always comes back to the pattern just prior to the news itself. So again, keep it simple. One of the reasons that I break it down this way is that I can cookie cutter my approach each day based on a certain window of time, based on what the information that the market provides for me, that's very simple to replicate, and based off price, and then using that window to look for my candle confirmation setups based on how Asia consolidates after the close of the market, and again, most importantly, targeting an asymmetrical risk-reward opportunity. That enables you to take a stop. You can take a loss, have a profitable trade that will wipe out all of your losers. But it's more about the psychology of knowing that at that point you are wrong, and being out of the market and having a clear head and being able to come back to the screen, reassess the market, and be able to get back in if there's an opportunity to trade that again in the right direction. So hopefully you got some value from today's video, traders. If you haven't done so, go to my homepage, get my 7-step daily routine for high performance traders. Ritualize your routines, set goals, get better every single day, accelerate your learning, be journaling your trades. One new thing every single day you should be learning from the market. No matter how small that is, it will pay big dividends if you're using that information to improve rather than just recycling the same things over and over and hoping that you're getting a different result. So stay disciplined, stay focused. We have the Brexit vote this week. I know there's going to be a ton of volatility throughout the markets in the next few weeks. There's going to be some textbook perfect setups that actually just follow this to a T. So hopefully you get some value from it. Hopefully it helps with your results this week. Have a great trading week, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.